has been something that investors have been mentioning for a while in terms of comparative analysis. And we've done a lot of effort around it in 2024 and in Q1. If you look at it, we've been able to, through efficiency gains, restrict the expenses growth to 7%, which sets us up well in terms of the improvement in our expense to revenue ratios. In addition to that, I think the results are also reflective predominantly of the trust that our customers have with HBL and the group, as well as our stakeholders. The key elements of the strategy continue to remain the same. That is essentially to improve people's lives by positively impacting Pakistan's economy. So therefore, we as a full-scale bank, cover all aspects. In the first quarter alone, we've been recognized for 3 different things by agencies. The first one is the Best Investment Bank Award by Global Finance. And then there is a Best Investment Bank Award by Finance Asia as the best domestic, investment bank. In addition to that, on the Islamic side, the Best Sukuk House by Euromoney Islamic Finance has also been awarded. So the confidence that is there, we also could contribute towards the real economy, leading in the agri and the SME space. And in addition, we also believe in working on initiatives, that help bring Pakistan more together, as well as a better positioning in the international market. So this year also marks 10 years of HBL PSL, where we've been successfully able to bring back international cricket to Pakistan. The other element is more on the business side. We have partnered for setting up HBL's partnership with S&P in terms of the Global Purchasing Manager Index, which really provides, for the first time to Pakistan, a tool that gives us an idea by industry segment, pretty much real time, every month, as to how the various sectors of the economy perceive the state of the appetite in terms of business dynamics. Is it a positive sentiment? Is it a negative sentiment? And what are the underlying reasons for it? So that is essentially used as a tool globally, as well as to compare against global benchmarks as well. On the tech side, we have partnered with Google to come up with Google Wallet that essentially allows you to leave your cards at home, and you have your device, which is your mobile phone, and you can tap and you can make transactions. So we will continue to partner on all elements as a full-scale bank and to continue to take them forward. What I'd request now Raymond is to actually run through a little bit of the deep dives and the presentation that we have for you.
Okay, thank you, Nasir, and hi everybody who's on the call. Thank you very much, as always, for your interest in HBL and HBL's results. Thank you also to Farhan and to Arif Habib for continuing to host our investor calls. So we'll run through the presentation fairly quickly and then turn it over for Q&A. So if we go to the first slide, we continue to have the largest number of touch points with 1,675 branches, 40,000 POS terminals, 51,000 connect agents, and so on and so forth. As Nasir mentioned, our commitment to development remains absolute, with between HBL and HBL Microfinance, 100 billion out to agriculture, 100 billion out to SME, and consumer lending continuing to grow, now reaching nearly 150 billion rupees, with the largest consumer book in Pakistan and leading market positions in personal loans, credit cards, and autos. Next slide, please. I think this gives you a very good idea of the depth and breadth of our business and the external and independent recognition that this provides. We have expectedly swept most of the awards in the investment banking space, and that's a testament to both the quality of the team as well as the strength and risk appetite of HBL. We go to the next slide, please. We have been for many years now on a drive to go more and more digital. I think we have been communicating this to everybody regularly. We now, our digital throughput this year for the first quarter alone is 7.7 trillion, which is up 35% year on year. 91% of all customer-initiated transactions are now processed digitally. If we look at mobile and internet banking, there's a nearly 60% growth in volumes. 3 years or 4 years ago, we were very excited when we processed 1 trillion rupees through our mobile banking in a year, and now we've processed 2.6 trillion in 1 quarter alone. Same thing on Connect, on our core business focus, 19% growth in our volumes, 32% growth in cash management, and our cards position remains dominant with 30% of all industry spend on HBL machines and 37% of all spend on credit cards being on an HBL credit card. Next slide, please. So total deposits grew gradually to around 4.5 trillion. The success story is current accounts, which grew by 127 billion in 1 quarter, which is our highest Q1 current account growth in the last 5 years. Advances, as one would expect after the ADR events of last year, have come off as they have for the entire industry. But as I mentioned earlier, in there, our consumer business continues to grow and set new records. In terms of our investment book, as you can see, and this is a question that often comes up, our fixed rate loans are increasing, our fixed rate investments, are increasing, and as is our duration, which was 0.83 in September and is now at nearly 1% in March 2025. But as we speak, by the end of April, that number is above 1. Next slide, please. So if we look at the P&L, the reported results are 36.6 billion, growth of 22% year on year. The core domestic business has grown by 32% to 35.6 billion. Domestic subsidiaries, there is a solid turnaround in microfinance. All our subsidiaries are now profitable. And our core international business, while on the face of it, has reduced, but that's because of one-offs last year. When we do a like-for-like comparison, the international business continues to grow. In terms of our core domestic business, net interest income is up 14% because of an increase in the average balance sheet. Margins have shrunk, but because we focused on current accounts and because we focused on optimizing our funding costs, margins are only down by 15 basis points year on year, despite a 1,000 basis point drop in CIBOR. Total non-fund income is up 17% to 17.6 billion, driven by excellent performance from Treasury. And on admin expenses, we've been saying for a while that we've been focusing on costs. In 2024, when we looked at the full year results, HBL's expense growth was 13% versus 27% average for the top 5 banks. Similarly, for all the results that have been published, including the top 5 banks, the growth in expenses right now is anywhere from 23 to 40%, and our growth is 4%. We had targeted certain key lines for reduction, and in those lines, we have achieved a 20% reduction. So the overall expense growth has been contained to only 4%. Next, please. So the main thing here is the infection ratio has jumped up back from 4.3 to 5.3. Nothing particularly surprising. The 4.3 was because of the huge buildup of advances at the end of the year. And as we said then, this was always expected to revert. But if you notice, it's still below all the quarters of 2024. So the infection ratio is modest and is better than most of the players in the industry. If we look at the net infection ratio, it's well under 1%, with our specific coverage at nearly 90%. Go to the next slide, please. So the ADR is normalized back to around 44. The capital adequacy, both tier 1 and total, continue to strengthen given the profitability dynamics. The NIM for this quarter, of course, shows a slight uptick, even though it's, of course, lower year on year. That, I think, will revert back down fairly soon, because right now we've got a very welcome situation where deposits have repriced down, but loans and investments haven't repriced down quite as much. That will normalize during Q2. The cost to income, we continue to try and drive this down, so which is now down to 55.6. The returns have, given the strong results, improved to a very respectable 18.5%. That's it in terms of the presentation. And I think maybe now we just go to the Q&A. Farhan, back to you.
Thank you, Raymond, for the detailed presentation. We'll now open the call for Q&A. Again, just as advice, please, you can use the raise hand button if you have a live question, while you can also use the chat box. You need to identify yourself and your company name whenever you're asking a question. We're not going to attend any anonymous questions. So our first question comes from the line of Syed Fawad Basir. You can now ask your question, Fawad. You can unmute yourself and ask your question.
Ji, Assalamu alaikum, everyone. Congratulations on the set of results. My question relates to the IT expense of the bank. So over the past 5 years, since 2020, the bank has almost spent about 78 billion in IT expenses. Now, if you compare this to the other banks, it's not even close to any other bank. So what is this expense for? Is it just systems? Is it just systems upgradation? And when will we start seeing it impacting the bank's profitability, if at all?
Okay, so if you look at the IT expenses, we have been investing in digital, we've been investing in software, we've been investing in CapEx. And that's an accumulation of that. We are now beginning to see the results of that. You've seen that in the way our digital transactions have grown. You've seen that if you look at our annual numbers also, you'll see that HPL is one of the very few banks where headcount is actually reducing as we process more and more transactions digitally. If you also look at IT expenses quarter on quarter, and you look at our first quarter numbers, you will see that these costs are now beginning to flatten.
Okay, thank you.
Thank you, Fawad. Our next question is in the chat box. It's from Walid Rathor. He's got a few questions. Firstly, what was the yield on T-bills, floating PIBs and fixed rate PIBs during 1Q CY25? And what are the average maturities of fixed PIBs?
Yeah, so if you look at the portfolio, our yield is around 13.7%. There's a mix of, the floaters are around 50 to 54%. Fixed are around 29%. So it's a pretty healthy mix considering the interest rate environment. The duration is, as Raymond said, that it's around 1, but we will be crossing 1 pretty soon.
Thank you. Just a follow-up from him. He's also asking if there was repricing in the first quarter and how do you see, I think, in the second quarter. I think that Raymond has mentioned about the NIMs coming down. So I think probably that part is already answered. He's asking if there was any repricing in the first quarter.
Yes, there are floating rate loans that reprice as per their frequency. Some are quarterly, some are semi-annually.
Thank you.
And floating rate EIBs rather, not loans necessarily.
We don't have any. Okay, now. So the next question is from Nihal Qasim.
Am I audible?
Yeah, you're audible.
Yes.
Yeah.
Well, I'd like to congratulate management on the results, first of all. I'm very, very pleased to see the expenses rising by an amount less than a percentage amount less than the other banks. I wanted to ask, there is a focus towards current accounts, as we've seen 127 billion during the quarter. Is this trend going to continue? Where do you think your current accounts will go as a percentage of total deposits? And on the other side, I wanted to ask, is there anything being done to increase the margin or the revenue per client so that the impact on NIMs is from both sides, a cost reduction as well as a revenue enhancement? Thank you.
Okay. So in terms of current account, this is certainly sustainable. If we look at our current account ratio, then after many years, our ratio of current accounts to total deposits has crossed 40%. Our goal is to drive this much higher to well over 45%. Whether we exactly get there this year remains to be seen, but that is certainly a first milestone before we try and move that even higher. We are certainly focused on cross-sell, and we have been trying to maximize products per customer. And you can see that in the last X number, I don't know, 5 years, 7 years, 8 years, consistently HBL is both the highest absolute number of fees as well as the highest growth rate in fees. So that is reflective of our cross-sell, whether it's trade, whether it's consumer, whether it's investment banking. We try and get the maximum share of wallet of the client. So therefore, it increases our non-fund income and eases the pressure on margins.
I think lastly, Nihal, what I would like to also add is we will also, in addition to cross-sell, continue to grow the assets, because the way the economic recovery is being planned, if that goes the way that it is expected to, we may see with the government curtailing its expenditure, less and less reliant, on government paper or issuance thereof. And in that case, I think it's critical that while the current accounts are obviously a no-brainer, as well as cross-sell of multiple products, but I think asset growth is also going to be a key component, and also a more rigorous balance sheet management that would be looked at from how the contours of the balance sheet look like. So we will continue to focus on all of the elements of the balance sheet as well as the income statement, and come up with the optimal efforts around it. I think that's our strategy.
Nihal, any further points?
No, and I just want to thank management for the increase in dividend. Thank you.
Thank you.
Thank you, Nihal. Okay, our next question comes from Mohammad Abrar from Arif Habib. Abrar, you can ask your question.
Hello everyone. This is Abrar Purani from Arif Habib. Basically, I have a question regarding the removal of the MDR. So what we have witnessed is towards the year end, the MDR was removed on the deposits of financial institutions, public sector enterprises, and public limited companies. So has this impacted or has this profited the bank in any case? And secondly, you mentioned regarding the normalization of names. So can you just like give a ballpark figure where your names could fall in the next quarter? Thank you.
Yeah, so I'd rather not give a projection of where NIMs would end up in the next quarter. But obviously, the MDR, the removal of MDR has helped on the conventional side. But as you're aware, there's also now an increase in the MDR on the Islamic side. So between the two, yes, there is a modest upside, but it's not anything that has distorted the results or I would classify as a one-off.
All right. Thank you so much.
Thank you. Our next question comes from the line of Abdul Muqeed from NBP Funds. Muqeed, you can now ask your question.
Thank you. Thank you so much. Okay. My first question would be related to your outlook on upcoming policy rate and overall outlook on the monetary easing cycle. When do you expect a monetary easing cycle, and at which level do you see the monetary cycles to end? And my second question would be related to your deposit target, and in a specific, if you can identify or mention about your current account deposit targets. And my last question would be, we have attended some briefings and there were some change in remittances commission structure. So if you can please also brief on that front, that would be great. Thank you so much.
Okay. So in terms of the monetary policy today, and we may yet be proved wrong by the end of this call, we are expecting currently, given the various headwinds and the overall situation, given the fact that there's an IMF board meeting in 4 days, I think one would expect that the interest rate will hold. Over the rest of the year, there is probably room for a further modest small cuts, maybe 2 cuts of 50 basis points before the end of the year. In terms of our current account target, we are at, we have crossed 40, and our target is to certainly, as a first step, get over 45. Now, in terms of the remittance, I'm not sure what your question was. Can you please repeat it?
Okay, yeah. So on remittances front, there were some banks which mentioned that there was some change in commission structure back in November 2024, and after that change, the banks which allows to take the rebates from State Bank have now reduced. So as per some briefings, the competitive landscape of remittances has now increased, and a few banks have also increased their marketing expenses on that front. So just wanted to have the clarity on overall development.
So I think it's similar, Mukeet, to the feedback that you have got from other sources, and it's no different. There was a change in the incentive structure in terms of tiering that has led to increased competition amongst the banks for market share. At the same time, we do believe that there will be further adjustments to the methodology by June, which would allow for a more sort of responsive marketing effort directed towards increasing the remittances, because clearly, like many other countries in the region, like Bangladesh and Sri Lanka, inward remittances are a key balancing factor. And I think we will continue to see efforts by the government and the regulators to ensure that that the potential is maximized through the formal channels. I don't want to suppose things that may or may not come in June onwards, but we're very hopeful that the steps that might be taken will further help, if anything else.
Right, sir. Right. All right. Thank you, sir.
Thank you.
Thank you, Murthy. Okay, we don't have any live questions. Now we can move to the chat box. A few questions here. First, there are a couple of questions from Sami Kumar from Topline. The first part is, what's your view on interest rates? Where do you see bottom? I think that one you have already answered. The second one is, what are your ADR targets for 2025?
Our ADR targets for 2025, we are at about 44%, and I think that is more or less where we will stay in the 40s, because I mean, we're not about doing anything stupid in terms of ADR, but at the same time, HBL has always said, and not just said but demonstrated, and we've always walked the talk on this in terms of supporting the real economy. We are the largest by far lending to agriculture, the largest by far lending to SME. And so we're certainly going to continue lending as a normal business. We're not shying away from lending in any way, shape, or form. And therefore, our ADR will remain in the mid-40s. You know, probably somewhere around 42, 44, somewhere around there. It depends on how, obviously, there's a denominator at the bottom also, so it depends how deposit growth pans out, because deposit growth should be fairly aggressive. And then the third factor is private sector demand. As long as there is credit demand, we're there.
Okay. The next question is from Saad Iqbal. What are your plans to cut admin costs? I think that's your favorite question.
Well, I think we've already demonstrated that we have reduced 20%. There are about 10 targeted areas we looked at, in which we've achieved a 20% reduction year on year. Not a reduction in growth, but an actual reduction in the expense. Also, the very fact that last year our expense growth was 13 versus 27 for the industry, and this quarter it's 4 versus over the top 5 banks, it's looking like somewhere around 25 to 30%. I think that says that we are continuing to focus on reducing expenses.
I would add one thing over here, that what we are doing is we are looking at where the opportunity is to save, but we're not going to impact growth, and we're not going to impact critical things that we need to do. So I think there's a smart way to do efficiency gains, and then there's a not so smart way. So I think that balance will be maintained, but clearly the track record is showing that we've done it thoughtfully. We're starting to see the signs of it, and we will continue to go down this trajectory as well as the automation path, you know, in order to, you know, get more logical saves, you know, versus, you know, something which is, you know, knee-jerk and is, you know, self-inflicted at times because you just go overboard. So I think balance is the key in order to continue to support growth, you know, while becoming more efficient and better automated.
Thank you, Nasir Saab. The next question is from Nadeem Elai Sheikh from Ali Asgar Textile Mills. He's asking that HBL is still on the MISIS system. Is there any plan to upgrade to a new banking software? If so, when and how much will it increase the annual IT budget?
We have been on a journey to embark to replace the IT software with Temenos. We started this about 3 years ago. We've incurred already a large portion of the cost is embedded, and we expect that we will be going live with the first few branches later on this year.
So clearly there is a focus there on the core application. In addition to that, there are other peripheral items other than the core, which are really critical for digital growth. So it's really part of the IT architecture refresh that we're doing. So just like you see our Connect app and other pieces, you see our mobile app, which is, you know, award-winning. So we will continue to also, in addition to the core, keep on at a holistic basis, upgrading the appropriate technology assets, as and when is required, in line with our technology architecture roadmap, which is synced in with the business requirements. It's primarily a business project, but obviously the enablers in today's day and age are all tech driven. And that's something that we'll continue to work through.
And by the way, I'm not sure if I said it or not, but we're moving to Temenos T24.
Thank you. Okay, the next question we have is from Sachal Abbasi from Sherman Securities. He's asking, what is the bank's deposit growth expectation in CY25?
I think the deposit growth expectation is somewhere between high double digits, 15 to 20%, in line with growth in nominal GDP, in line with growth in M2. So we and given that 2024 December was a low base because of the ADR impact, I think somewhere around 17, 18%, I think is a reasonable number to take.
Thank you, Raman. We don't have any further questions. And while we wait for questions, I just wanted to ask a couple of questions on my side, and taking advantage of Amir's presence as well. Amir, on the corporate lending side, obviously rates have come down, but we've still seen that as other factors of the economy have improved, our LSM growth remains really challenged, even in the third year running. How do you see, from your sort of vantage point, dealing regularly with clients, what's your view on the pockets of opportunity on corporate lending in the next 3 to 4 quarters?
Look, I think, let's put it in perspective. As a commercial bank, where we were exactly first quarter last year, where we are today. If you talk to anybody in the banking sector, they'll tell you we've come a long way. That's from a macroeconomic point of view. I mean, last year we had issues opening LCs for customers. Pakistan was at the brink of defaulting a lot of obligations. So things from a macroeconomic point of view, things have improved. Unfortunately, domestic demand will take some time to come back, because you have to realize that in 2 years, there was 38% inflation, there was close to a 70% devaluation. People's incomes have not caught up to that level yet. So while we're seeing recovery, the domestic demand is, construction is still slow, and obviously construction is like 14 industries associated with it. So numbers are inching up. I mean, people are not making losses. 2 out of 3 problems have been sorted out. Every company in Pakistan had 3 issues. One was the commodity prices, because the Ukraine war, they jumped up. The second was obviously the higher interest rates, which are now halved. The third problem still persists, obviously, but the government is working hard on trying to fix that, which is the power cost. So, 2 out of 3 issues that industries faced are kind of normalized. The third one is obviously the major issue facing most of our customers. To say that there's going to be growth, growth will either corporate lending or investment banking business is impacted by the demand. So if the demand goes up, obviously reinvestment will happen. Right now, the demand is growing, but it's very, very slow. If you flip it around to the export sector, the major issue is obviously the tariffs is a new issue, but demand for Pakistani products, especially in the textile industry, finished goods space or value-added space, is very much there. In fact, even before this global tariff issue, China and US had an issue, because of which a lot of customers had actually moved some of their business. New customers had come into Pakistan, wanted to diversify out of China. Then Bangladesh had an issue. We got a few customers coming in from there. So the market is there, the inquiries are there, new orders are there, but margins, again, coming back to the challenges in power costs, gas prices, the margins are very thin. So I don't think that we're going to see a boom in new projects coming in or real expansions coming in. But as Pakistan's demand, consumer demand catches up, domestic demand catches up, obviously there will be capacity expansion. So either working capital lines will get drawn again, because right now anybody who had money at 22%, they were giving the bank a return which is an equity return. So everybody who had money plowed their own money into their business rather than borrowing. So the working capital side is easing, but new investment, I think, will take another 6 to 12 months.
Okay, thank you so much. I just one other question, Raymond. We saw an uptick in the international lending, which you discussed on your presentation as well. I mean, how are we seeing the international operations, and what sort of outlook, if you could sort of share there, and probably pockets of opportunity there?
So international, was a drag for many years. Now, for the last couple of years, international has been profitable. We have turned that around. We have pruned non-productive businesses. We have pruned non-productive branches. We are now very focused on the kind of business we want to do in international. We've closed a number of countries and are in the process of closing a couple more, which is all as per disclosed in our accounts. There's no surprises there. But also at the same time, we've refocused our business model to focus on our network. So our network clients, which is the number of clients with whom we do business in multiple locations, that also continues to increase. So we focus on doing, again, there was a question earlier, but we focus on deepening our share of wallet with those customers. So if we have a customer in Bangladesh who we can service in Singapore and who can service in the UAE, we're doing that. We have a very large base of Chinese customers based on the fact that we have a presence in China. And that helps us to service Chinese customers along all the Belt and Road countries, whether it's Bangladesh, Sri Lanka, Maldives, UAE, Bahrain, and so on and so forth. So I think international has now, in a sense, reduced scale, but a more focused, more efficient, and more profitable operation.
Okay, thank you, Raymond. I think we don't have any further questions, and let me just check. We might have one more. Okay, we just have one follow-up question from Sunny Kumar. He's asking, did HBL pay windfall income tax on its foreign exchange incomes for the years 21 and 22 as per the High Court decision? If so, could you also quantify the amount?
Yes, we have paid the amount. I would rather not quantify the amount specifically, but yes, we have paid as per the High Court decision. All the banks paid, and so did we.
Okay. Okay, so we don't have any further questions at this point in time. I think we can conclude, I suppose.
Okay, Farhan, thank you once again for hosting.
Yeah, Nasir, have any last sort of comments? Sorry, please go ahead.
No, I think future outlook, we're looking at it optimistically in terms of our plans, and the hope and expectation is that the economic recovery and the growth engines continue to support. But like Raymond said, I think our plans are there. There are certain things that we will continue regardless, which is the investment in technology, which is the engagement with the customers, continuing to provide the right opportunities. So if there is FDI, there are other elements, as you saw with some of the accolades that I covered and Raymond covered, we're best positioned in the first port of call in many ways for investors that are coming in. So I think cautiously optimistic, would be the right note to end it. But the big thing is that first quarter has gone off to a good start, and I think that's one less thing to take care of. and we'll work through the rest of the three.
Thank you, Nasir Saab. Very strong sets of results, and congratulations on that. And we wish you all the best for the rest of the year.
Thank
Thank
you,
you.
Farhan, you and
Thank you. We
RF
can
team
conclude this
for
call.
hosting. Thank you.
Thank
Thanks,
you.
Farhan. Thank you.
Thank
Thank
you.
you.
All the analysts and everybody who's taken the interest in attending this call.
Thank you.